Hey y'all, hey, it's JJ Conway. Welcome to Building Wealth Together, where our goal is to help you walk in abundance and leave a legacy. It's Wealth Building Wednesday, where we answer your money questions with style and grace. To ask your question, go to buildingwealthtogether.com and click Ask JJ or leave a voicemail at 1-833-4-ASK-JJC. Let's get into it. All right, everybody, we've got some great questions for you today. The first one has some congratulations in order. This person sold their house, turned in their lease car, and was able to pay off all their outstanding balances on medical bills and credit cards. They also have $15,000 left over. They want to purchase a car for $5,000, which will leave them with $10,000 left. They're going to keep their $1,000 emergency fund, and they want to kind of know what else they need to do. But I want to stop and celebrate them right now, because this person went from $196,000 in debt to only $38,000 left to pay on their student loan, which was in 7 months that they've been on this debt-free journey. So woo woo, congratulations. And so the question is, hey, should I put this $9,000 towards the student loan, or should I keep adding to the savings until I save up the full amount to make a lump sum payment? And I do believe I actually spoke to this person in person. And the answer to this kind of question really depends on whether or not you understand. The answer depends on the terms of the loans that you have, the student loans that you have. And there's a couple different things that go into student loans. Y'all know I hate student loans. I promise I'm not going to go on a rant, okay? Although I might with the next question. With student loans, there's a couple of different terms you've got to watch out for, okay? So it depends, some of it depends on whether it's a privatized loan or if it's a government-backed loan, how they handle things. A lot of privatized loans, there's no regulation. So they can do whatever they want to do. And so what I would caution you is to really dig into your loan information and make sure that paying a partial amount now that's different than your payments isn't going to add extra fees. It shouldn't, but I always like people to check, because I've had some people who are like, you know what, I followed your advice, and then they hit me with this, and it's like, whoa, I'd never heard of that before. So, it was in there, but, well, they should have come to me before they did that. They shouldn't have just followed my advice from one person. So I guess this is a really good time to tell you, just because one answer sounds similar to your question, sometimes there's details that maybe if I've already spoken to the person, I may not share those details online, but there may be more details to the situation. So before you go and act on anything that you hear from me or Clark Howard or Dave Ramsey or anybody like that, right? You're going to want to make sure that you consult with somebody to see what applies to your situation and what other things are out there. And one of the things that are out there is that a privatized loan can have any clause that bank wants to put in those contents and in those requirements and in your agreement. So you really, really, really got to understand what that is. All right. So in this particular person's case, that was some homework that they needed to do, is kind of find out what the terms are. But I am a huge fan of paying your debt as soon as you can. Now, there are some situations, and in fact, I can't remember exactly with this individual, but once they brought me back, their homework was going to determine which way we went. But I thought they might have some significant life events coming down the pike where I would recommend they put more into savings. So, there's some times that we don't always just throw everything at debt, but there's just something about getting it out of your life. Right? And speaking of getting things out of your life, there's one thing right here I'm going to recommend the next question asker get out of her life. And that is, she is a co-signer for 2 college students. I almost thought about going on a college loan rant with this question, but I decided not to. What I am going to do, however, is I'm going to direct you to what my church posted as today's daily proverb. Okay? Today's daily proverb. And it's funny because the context in which the proverb was talking about how people misinterpret scripture, but the scripture came from Proverbs, the 6th chapter, and it's the passage from the 1st down to the 5th verse, which basically says if you've co-signed for somebody, in the Bible they call it surety, being surety for someone. If you've co-signed for somebody, Get yourself out of that situation as fast as you can. The Bible says, go humble yourself, secure your friendship, get yourself out of this thing. Don't even go to sleep until you can get out of this. It says, deliver yourself. Deliver yourself like the deer from the fowler, from the hunter. All right. And so there's one thing that I'm going to tell you. If you are a co-signer for 2 college students, run as fast as you can and as soon as you can. But accept the fact that for the most part, the reason the bank has you co-signed is because the students aren't going to be able to pay it. And they know that traditionally, the students don't just graduate and go get a good job and pay those loans back. I don't want to sound mean and sound like people take advantage of people, but I remember being a college kid, and I remember my roommate saying, "Hey, let's go party on my parents' credit card." And we had just visited her parents, and I was like, "Your parents sat you down," and I don't know why they had me in that conversation. It was so uncomfortable, y'all. Well, your parents just sat you down and told you how much debt they were and how you had to stop wasting all their money. And she was like, "Oh, don't worry about it. They'll figure out a way to pay it off." And I tell you what, that was the instant I began to realize that I was not going to cover everything for my kids in college. Up until then, because I had to scrimp and save and work for everything that I had totally thought I was going to give my kids a free ride. But when I saw the attitude of my roommate and several of the others whose parents were basically covering everything for their expenses, I was like, oh no, because they didn't appreciate it, and they didn't appreciate the sacrifice that parents make. And I'm not saying that your kids aren't great. My kids are the same way. They're great kids, but they just don't know. It's just life. Life has to teach them some lessons. And if you're already in the situation, there are definitely some strategies we can look at to try and transfer some of that. But the bank is not going to let you off of that unless the student, him or herself, takes on that loan. Okay? And you and I both know that is very rarely likely to happen. So if you're listening to this and you're thinking that you need to sign on some parent loans for your kids so that you can get them through college, I need you to understand, A, you don't have to do that. And B, you may be hamstringing your future. Our kids are cute. They are resourceful. They are young. They have time to recover. They can find a way to make things work. They do not need us to hamstring our future, our retirement, or our health in order to give them a quote-unquote leg up. I promise you this. Your kids will be okay. I mean, really, you'll be okay too. I mean, you might be eating dog food in your retirement, but you'll be okay. God will take care of you. Some say the government will. I'm not so sure the government will be able to in a few years, right? But I tell you what I don't want for you. I don't want you to be like this couple that I met when I was at a Whole Foods one time, and they were sampling all the soups, and they were a very frail, thin, elderly looking couple, and they lived in one of the trailer parks. They came down for the winter down to Tampa. And the guy was trying to make his retired life sound so amazing. And I could see it on his wife's face. She was supporting her husband, but you could see it on her face that she was embarrassed. Because that wasn't just them sampling the food. That was their meal for the day. And I would see them several times, and that was what they did. They went from store to store getting all the free stuff, and they did what they could to get by. That's not the life I want for you. I mean, if you choose to live a nomadic, traveling around and very frugal life, I'm good with that if that's your choice. But I don't want that to have to be your life. And they had 2, 3, I don't remember how many, but they had kids who made it through college, but they spent so much of their life doing what everybody else is doing that they ended up broke. And I don't want you to end up broke like everybody else. I want you to have a retirement that's full of life and abundance. So you're a college student, co-signer for 2 college students. If you can get yourself out of that, please do. But if you can't get yourself out of it, consider it a very expensive life lesson, never to do it again. All right. All righty. Let's see. Someone else said they'd like to wow, I wish I would have seen this one. Well, they didn't book with me, so maybe they found somebody else. My wife and I would like to speak with someone about financial coaching and go ahead and build a house. I think building a house is a great idea as long as you can do it at a reasonable price. if you're paying things as you go, or if you're able to get the kind of loan, like you put 20% down or 15% down, you can do the kind of loan that gives you the draws and the construction loan and all that stuff. If you can get all that stuff together, go for it. But make sure that the numbers work and that the numbers are going to be a blessing and not a cursing. All right? Okay. Now this is funny. This next question is funny to me. Okay? This one is, do we keep this house, which we owe about $75,000 at 4%, or do we sell it and buy a new one for which the debt would be $150,000 at 2.4%? And I see what they're doing here, right? They're looking at numbers. They're like, okay, $75,000 at this month, $150,000 at that amount. Well, you can't just look at interest rates. You got to look at a couple other things. You've got to look at the terms of the loan. You got to look at how long you're paying and what's the term they stretch it out for. Because see, a real estate loan isn't a simple percentage. Okay? It's not a simple, oh, you have a $100,000 loan and you have 2% interest rate. Okay, so 2% of a $100,000 loan, what is that? $2,000. So we're just going to take $2,000 and we're going to spread that out over 30 years. That is not how they work. Okay, there's an amortization schedule, and your $100,000. Well, this one here, your $150,000 house. You know, I could have done it before we started recording this live, but you can calculate it out. It's not going to cost you $150,000 plus 2% of that. Okay, it's going to cost you a lot more, and so you want to calculate those out. And straight math might say, oh, well, you know, I could get more house for the same interest. But what are your payments going to be? What are your taxes going to be? What are the requirements of where the new house is? If your old house is in a flood zone and you got to carry flood insurance and the new house isn't, well, maybe buying the new house is cheaper. We got to look at your income. If you're asking me about the difference between a $75,000 house and a $150,000 house, well, in your mind, this is what I think you're doing, is saying, oh, well, my payments are going to be the same. And I don't think you can say that. I think you need to calculate it out, right? But the other thing you got to look at is, what is your income? If you're making $150,000 a year, I don't know that it matters that much. If you're only making $40,000 a year, that makes a bigger difference. So we got to look at those kinds of things, right? Because you don't want to have too much house. You don't want to be house poor. I think when I went through George Mason for my financial planning certificate, I think they were saying, you know, you want to have about a third of your take-home income wrapped up in your house. And me personally, I think you should drop that down to 20% to 25% of your income, because you need the other income to achieve your other dreams and your other goals. Okay. And so in my opinion, it's actually better to live down in house a little bit so that you can achieve your other goals. And for example, when buying the house, you might want to have this big fancy house, but you know what's actually maybe a better financial decision is to get a smaller house in a fancier neighborhood. So instead of having the biggest house on the block, you have the smaller house on the block, but in a nicer block. All right. These are the kinds of little things you consider when you're buying a house to make sure that what you're buying is the best financial decision. I just had a consultation with somebody the other day that was like, we're sold on getting this house. My cousins are there. I love the area. We know we're going to be there for a while. And I was like, okay, as long as you know that you're going to be there for a while and you guys have saved up enough. They had saved up enough. I mean, there were other factors that I wasn't too happy with their situation, but they had saved up enough that they could safely buy the house, right? And to my thing though is, we don't know what the economy is about to do. We don't know what this government is about to do. We don't know what's going to happen 5-10 years from now. And the last thing you want to do is be house poor. You don't want to have all your paycheck going to pay a mortgage. And heaven forbid you go and get you one of them interest-only mortgages thinking that, oh, everything will appraise and in a couple of years I'll just, I'll have invested the difference and be able to pay off my house. Like, that's what they sell you on, but I haven't seen anybody that actually worked out for. In fact, I remember when that used to be popular before. The last time that was a popular strategy, That was when, right before the bubble burst, and all my friends were getting these interest-only loans on their properties, and they were pressuring us because it was like an MLM. It was like you sign up your friends and you get a kickback, right? They all went on cruises. They all did painting. They all bought new furniture. But let me tell you what they didn't do with that extra money that they had after they refinanced into an interest-only loan. They did not invest it. And that's what most people do. We think about math and we say, oh, look, this could work. But debt and wealth isn't just about math. It's about behavior. And our behavior generally has shown that we don't always act in the best financial interests. So just follow the principles, the broad, time-tested strategies that we talk about, and you'll be all right. Okay, let's go on to the next question. The next question says, I can't afford the jump in premium on my universal life policy that I have had for 30 years. There's $1,200 cash value on it. When I terminate it, what should I do with the money? I'm 63 years old. I own an annuity policy. Should I put it there or look into term insurance? All right. I was just looking at getting some more term insurance myself, and I'm not quite into my 60s yet, all right? But I am older than I look, but I'm not quite where you are. And I already looked at that and said, wow, for that money, I might as well just invest it in the market and transition that to my heirs later, okay? So I don't know how much value you're going to get with term insurance at 63, but there's not enough information in this question for me to be able to tell you what you should do or advise you what you should do with $1,200 cash value. Okay, so let me just run through a couple of different scenarios. When we get insurance, for the most part, insurance is to take care of the income our families will miss if we are gone. And by income, I don't just mean monetary income, but also the value that you provide to the household, okay? So my husband is very gracious. My income, I get to do what I want with my income, and he takes care of everything. And I think that's absolutely wonderful, right? But even though I don't really contribute to the household, I do take us on trips, y'all. But even though I don't really contribute to the household, I'm chuckling because I'm like, if he ever died on me, anybody else that wanted to step in, I think I might be too spoiled. But anyway, even if I don't contribute financially to the household for reals, right? There's a lot of value to managing the household. There's value to taking care of the meals and making sure my family has healthy home-cooked meals. There's value to managing the schedules. There's value to managing all the household laundries and chores, even if managing that means making my teenager do it, right? There's a whole lot of value that you bring to the table, whether or not you're actually bringing monetary value to the family. And so, if you have a traditional arrangement like me and my husband do right now, you might have what we recommend is you put about 10 times the value of the income from the wage earning spouse, have insurance for them for about 10 times their work, so that the spouse who's remaining, if the wage earning spouse dies, if my husband were to die, I take the money from his insurance, I invest it. Now every year it kicks out enough money to make up for what I lost when I lost him. It can't make up for the companionship, and there's quite a few other things those dollars cannot make up for. You know what I mean? But it at least makes up for the bills and the house and all that other kind of stuff. Okay. On the flip side, for the non-wage earning spouse, you can average about $50,000 to $80,000 to $120,000 a year, depending on the size and reach of your household. Okay, a household that I grew up in, probably more like on the $45,000, $50,000 a year side as far as managing that household. The generals that we worked for, where he had an entire staff, like I did the social planning, and then he had an aide who did his cooking, and then he had another aide that did all these other things, like all of those people together, right? All of that value, all the value of all of us that did all that stuff for them, that's way more, right? So if you have a family that you have a lot of social commitments to further your husband or your wife's career and all those things, and you're always planning those things and you're always doing all that, well, it's going to be more on the higher end. But I guess I'm rambling a little bit. Sorry, y'all. But what I'm trying to explain is insurance isn't just to take a big chunk of money and give it to people when you die. Insurance should be a risk mitigation. My husband has insurance to mitigate the risk that he dies on me and leaves me with money. I mean, with debts, or not debts. That didn't come out right. But with bills to pay, or with things, or that I can't replace his income, or, I can't work and he's been the one working. I actually do have insurance on myself. I have term insurance on myself to make sure that if something happens to me, my kids can go to college, my husband can hire a maid, things like that. Okay. So I feel like I'm taking way much longer on this question than I should have, but that's the first thing that you want to consider when you're looking at insurance and whether you need it. If you don't have any kids, or if you don't have anybody you want to pass money on to, you may not need it. Now, you may still choose to get some. In fact, one of my financial professors, he used to say every family, there should be no family in America, no middle class family in America that shouldn't have their next generation be millionaires, because everybody can get a good life insurance policy when they're young, and they can pay it off and have that policy, or invest in the market and transition that IRA. Some of those things are a little murky for me, because I feel like there are a lot of there's a little bit of smoke and mirrors there in the insurance world, right? But at the same time, there are situations where keeping a policy, actually keeping a whole life kind of, or universal life kind of policy could help. So, for example, special needs. And I'm not a big fan of these policies, I'll be honest with you, but there are onesie-twosie situation where it's good to have help, okay? So the first thing you want to consider is, what is the money going to be used for? And if it's not to replace your income if you die, then you have to be realistic about what is that money for. And we get sold a lot of things with insurance, and I don't dog insurance, folks. Okay, I love insurance. I think it's one of the best ways to mitigate risk, right? But I remember sitting in a seminar where they were doing a call for financial planners. They said, hey, we're looking for financial planners to help empower women financially and help them break free of financial bondage. And I'm like, hey, that's what I do. And I'm trying to get my CFP, so I need hours, and let me go volunteer with these folks, right? Well, I get in there, and it's a sales pitch for a particular multi-level marketing company. And basically what they wanted us to do was to go out and teach broke women that they needed to take out a whole life policy so that they could build savings in the whole life policy and take tax-free loans from their whole life policy whenever they got older. And I was like, why would I teach people to do that when I'm teaching people to invest in their real estate in self-directed Roth IRAs? That when they get older, the entire amount is tax-free. And the entire amount belongs to them. They're not taking a loan against their policy. They own the policy. They own the account. And so you got to understand what it's for, and then you've got to understand how it works, and you've got to understand whether or not it's helping your goals. And so I had a client a couple months ago that had an insurance policy. She had no children, but what she wanted to do was pass money to her mom and to this person, to that person. I was like, well, that's really great, but you can't afford it. So let's look at other ways to achieve your goals. But if you can afford it, go for it, right? Now, in this case, with this person's question, I've talked about a whole lot of different things, but like I said, there's not enough information to say where she should put it, because it really depends on where she's at and where she's going to go. With $1,200 cash value, do you need that for an emergency fund? Do you need that to pay down debt? Do you need that for this or that? Do you have grandchildren? Do you have grandchildren that are going to need to go to college soon? Maybe you drop that in a 529 for them. Did you know that grandparents' 529s that they establish for their poopy-doos do not count against the FAFSA? Okay, so maybe you want to do something like that. It really comes down to what are your individual goals. And this is why I highly recommend that anybody who's got a financial question, that you reach out to a financial planner or a financial coach. I'm both. We could help you figure out what's best for you. And you especially want to look for somebody that is a fee-only financial planner. That means I don't get kickbacks from the insurance company for selling you into a particular policy. And I don't get kickbacks from this company, this investment company, or that investment company for putting you in a particular investment. A lot of times when people get kickbacks, not all the time, because there are some quote unquote honest brokers out there, but a lot of times when people get kickbacks, they do things what's in the best interest of their pocketbook, not what's in the best interest of your pocketbook. When you bring in a fee-only financial planner like me, you get somebody who's got your fiduciary interest at heart. We are ethics and honor bound to put your financial needs first. That's what you're paying us for. That's why you're paying us. So you can go to the bank and you can get you a free financial advisor, but guess what that free financial advisor is going to do? They're going to steer you to all the stuff that the bank has. And if the bank doesn't have those policies, then they may not want you to see those. If the bank gets kickbacks from the particular companies, those are the ones they show you. And I'm not saying that to say it's slimy, okay? There's a lot of industries that work that way. I'll give you another example because we talked earlier about buying a house. All right. I'll give you this example, and we're almost out of time for today. Wow, time flies when you're having fun. So when I was a realtor, one of the things that I did is we would always do 7% commissions. Standard real estate commission is 6%. 3 goes to the selling broker, 3 goes to the buying broker. And then that broker splits it with the salesperson. So your poor little realtor, I in the military, we move a lot. And so when I was active duty, I would always hear coworkers talking bad about realtors and how they find all these tricks to milk realtors out of their commission. Well, I tell you what, by the end of the day, that realtor, a good realtor, really works hard for their commission, and they don't actually earn a whole lot after they have paid for your photos and paid for this and paid for that and paid for this advertising and all that stuff, right? But one thing I knew as a realtor, if I have a choice to show somebody a house where I could make $3,000, or I could show somebody a house with a 1% listing where I'm only going to make $500, I'm going to give priority. I shouldn't if the other house is right for the client. And me personally, y'all know me, I'm going to do what's right for the client. That's why I didn't last long in a lot of places. But that's why I still get real estate referrals. I haven't been active for like 5 years, and I still get real estate referrals, right? But most people, let's just be realistic. Most people are going to go after the $3,000 commission. That's why I would set a high commission. I wanted other brokers to bring their clients to my properties so we could get them sold fast. And the more eyes on, the faster it gets sold, okay? So again, let's keep those kinds of things in mind when you're looking for help, all right? All right, I think we can squeeze in one more quick question here. I have $1,500 investments with a regular brokerage account. Should I take that money and put it into savings for school tuition or other needs, or should I keep it where it is and leave it to grow? This question requires a whole lot of consideration, so I'm going to give you real quick some basics. If it depends on debt, okay? If you have a ton of debt, I'm not going to recommend you leave your money in the market when you've got a ton of debt, because your debt is actually growing faster than the interest is growing in the market, okay? Your debt interest rates generally, like on credit cards, and don't talk about them furniture bills, that's usually growing faster than what you're making in the market, okay? The next thing is, well, how soon do you need it for school tuition? Are you going to school next year, or are you going to school 5 or 10 years from now? If your $1,500 in an investment account is being used for school tuition 5 years from now, well, you could leave it in there and it would probably grow. But you never want to leave that to chance with a less than 5-year time horizon. So if you need that money before 3 to 5 years, I would put it in something safer. It's not going to grow, but it's not going to go. All right. All right, y'all, I'm JJ Conway. Thank you for being with me tonight for our Wealth Building Wednesday. Y'all take care and be blessed. Love the podcast? Be sure to like, subscribe, and forward to 3 friends. You can ask a question or take a life-changing class at buildingwealthtogether.com. Now, go walk in abundance and leave a legacy.